In this and the next few sessions, we will look at various facets of interest rate risk, what causes interest rate risk, how to measure and manage interest rate risks using techniques such as the repricing model, the duration model, and derivative instruments such as interest rate futures and interest rate swaps. Interest rate risk refers to the sensitivity of fluctuations in income and market capitalization of any financial institution due to changes in interest rates. Interest rate risks originate from mismatches in the repricing of assets and liabilities, as well as changes in the slope and shape of the yield curve. We will look at measuring and managing interest rate risks in great detail in subsequent sessions. In this session, we will focus on the type of interest rate risks. The first type of interest rate risk is the rate level risk. As we all know, interest rate is the price of money, driven purely by demand-supply economics. Accordingly, the price or interest rate will go up or down depending on the demand-supply equilibrium. When money supply in any financial system exceeds the demand for money in that financial system, interest rate would fall and would rise if the demand for money exceeds the supply. Interest rates could also be impacted through regulatory intervention. For example, based on our discussion earlier on cash reserves, a reduction in the cash reserve requirements by the banking regulator in any country would increase the money supply in the financial system and consequently impact interest rates downwards. Converse would be the case when the regulator increases the cash reserve requirements. Do remember, increase or decrease in interest rates will impact the cost of all the liabilities and earnings from all the assets that are sensitive to change in interest rates. This in turn will impact the net interest income. We will look at that in great detail in the next session. Second is the yield curve risk. This risk is encountered when shifts in the yield curve adversely affects income or the underlying economic value of the financial institution. 3. Prepayment risk. When interest rates fall due to favorable macroeconomic factors in the country, borrowers with fixed rate loans would want to pre-close their loan, since they would now be in a position to raise fresh loans at a lower interest rate. Similarly, issuers of bonds with a call option would want to redeem their bonds, and investors in bonds with a put option would also want to exit those bonds prematurely. These actions would naturally have an impact on the balance sheet and profitability of banks and financial institutions, since a substantial part of their assets and liabilities are sensitive to movement in interest rates. Number 4, basis risk or spread risk. This refers to risks arising from the cost of liabilities and the yield on assets being linked to different benchmark rates. As an example, the cost of US dollar liabilities in the balance sheet of a financial institution are, say, linked to the US dollar T-bill rates, whereas the US dollar assets in the balance sheet of that institution are linked to the US dollar LIBOR rate. Basis risk arises whenever these two benchmark rates do not move synchronously. 5. Real interest rate risk. Please recall the Fisher equation, which states that nominal interest rate is equal to real interest rate plus expected inflation. Recall the formula: 1 plus IN, which is the nominal interest rate, is equal to 1 plus IR, which is the real interest rate, into 1 plus EI, which is the expected inflation. Real interest rate risk is said to arise whenever changes in the nominal interest rate in the domicile country of any currency is not in sync with the expected inflation in that country. 6. And finally, repricing risk. This is perhaps the most significant type of interest rate risk, arising primarily from the difference in maturities of assets and liabilities that are sensitive to movement in interest rates. The problem is further compounded if the magnitude of the impact is asynchronous, say more fixed rate liabilities and more floating rate assets. We will understand those nuances in greater detail in the next session.